Money, career, and the art of preparation. Navigating the economic shifts of 2026. Part 4 of 6. The market is green. Your neighbors are celebrating. Your social media feed is full of gains. And that quiet voice in the back of your mind asks, is this real? Here is the honest truth. If your financial strategy for 2026 is the same as it was for 2023, you may be in trouble. Not because you have made bad decisions, but because the ground is shifting beneath everyone's feet. Do not mistake momentum for safety. So what is actually shifting? 2026 sits at the convergence of what this framework calls triple fire energy, a fire horse year within a 20-year fire period that began in 2024. And in the ancient elemental system, fire melts metal. Metal represents the architecture of financial systems, banking, currency, and established trade structures. This does not mean the system collapses, but it does mean systemic pressure will reveal hidden fractures. The strong survive, the weak buckle. Think of it like a stress test. The purpose is not to break the system. It is to show you where the cracks already exist. That is the lens we will use for the next 10 minutes. Region by region, sector by sector. Where are the cracks? And where is the solid ground? Let us start with the world's largest economy. Here is the number that should stop you in your tracks. The interest payments on America's national debt are now on track to exceed the country's entire defense budget. The world's biggest economy spends more servicing past borrowing than it spends defending itself. And the political system cannot address it, because both spending cuts and tax increases are toxic. So the problem grows quietly, like a cavity you keep ignoring, until one day it becomes a root canal. The risk in 2026? Treasury bond auctions. If major buyers, particularly foreign governments, reduce their purchases, interest rates spike and borrowing costs explode. The foundation is not crumbling yet, but the cracks are visible to anyone willing to look. There is a pattern in the U.S. economy that traditional averages completely hide. Look at this chart. Two lines diverging from the same starting point. The top line, asset owners, tech giants, knowledge economy workers, doing spectacularly well. Their world looks like prosperity. The bottom line, traditional industries, workers without significant assets, stagnant wages, rising costs, a persistent sense that the economy works for other people, but not for them. Both realities are real. Both exist at the same time. And this divergence is itself a source of instability. Because when too many people feel excluded from prosperity, the social contract frays, with consequences that eventually reach everyone, including those at the top. Now the question that keeps everyone nervous. Is AI expanding the economic pie or just moving wealth around? Remember the dot-com bubble? Every company needed a website, billions invested on hope, valuations detached from reality. When the correction came, trillions evaporated. Now look at today. Every company says they need AI. Over $100 billion spent annually on infrastructure. And the critical question is whether current stock prices already reflect changes that have not happened yet. If the answer is yes, a repricing is inevitable, regardless of how real the technology is. Amazon was a real company in 2000. Its stock still fell more than 90% before recovering. The risk factors are specific: overbuilt hardware capacity, potential engineer layoffs at major firms, quarterly earnings that show impressive capabilities but disappointing returns. A correction would not kill AI, it would reset the price tag. Now here is the slide you might want to screenshot. August through October 2026. A critical window for a potential market correction in the range of 25 to 30%. This is not a certainty. Markets are complex systems, but the underlying conditions for a major correction are present, and the seasonal energy pattern amplifies the risk. The trigger? It is always obvious only in hindsight. What matters is the gap between market prices and economic fundamentals becoming unsustainable. If you remember one thing from this video, let it be this: the most dangerous moment for investors is when everything feels safest. The first half euphoria that we talked about on that opening slide, that is the setup. This window is where the bill might come due. The practical response is caution, not panic. There is a ticking time bomb that has not gotten the attention it deserves. 2026 is a peak year for commercial property loan maturities, billions in debt coming due. But the properties backing those loans are worth far less than when the loans were made. Offices sit partly empty. Retail spaces struggle against online commerce. Here's the chain reaction. Loans based on pre-pandemic valuations meet post-pandemic vacancy rates. Regional banks hold a disproportionate share of this debt. Defaults trigger a slow grind of bank failures, not a single dramatic event, a steady erosion of local economies across the country. Every domino is already trembling. Now let us cross the Atlantic. Europe faces what may be its most severe economic challenge since the rebuilding era after World War II. And unlike then, there is no Marshall Plan on the horizon. The core problem is energy costs. Factories that operated profitably for decades are now uncompetitive. Chemical plants and steel mills are shuttering or relocating. And Germany, the traditional engine of Europe, is being hit hardest. Its automotive crown jewel faces a twin assault. Energy costs from one side, Chinese electric vehicle competition from the other. Major layoffs have begun. Factories are shuttering. The constraint is clear. No rescue plan is coming. The US dollar faces a fascinating paradox. If a geopolitical crisis erupts, military conflict, oil disruption, money floods into dollars as a safe haven. The dollar strengthens. But if the crisis is about US debt itself, money flees the dollar. It weakens. Both scenarios are plausible in 2026. The dollar could strengthen and weaken at different points during the year, depending on which crisis dominates headlines at the time. And then there is gold. Despite being metal in the elemental framework, theoretically weakened by fire, gold thrives on exactly this kind of uncertainty. Crisis drives safe haven demand. The watch window is June to October. Here is the irony. Fire melts paper gold, but physical gold becomes the shelter from the fire. Now let us turn east, to a story that most Western headlines get wrong. China's economy is not dying, it is transforming, and the difference matters enormously. Look at this slide. Two Chinas side by side. On the left, old China. Property development and infrastructure still unwinding. Tier 2 and Tier 3 city real estate deeply distressed. Consumer confidence fragile. This is the China that dominates the news. On the right, new China. Electric vehicles, solar panels, lithium batteries. The three industries most central to the global energy transition. Chinese companies now dominate all three. The technology sector shows structural strength that may support sustained growth. The pattern analysis suggests a second-half recovery, not the dramatic bounce optimists hope for, but genuine improvement toward year-end. The key insight for anyone watching from outside? Update your mental model. The opportunities are shifting from property to technology. Those still looking for the old playbook will miss the new one entirely. Japan in 2026 looks deceptively healthy, like a warm day in late autumn that makes you forget winter is coming. Stock markets may rally impressively. Military spending creates economic activity. Tourism is booming. On the surface, revival. But look underneath. The yen could fall to historic lows against the dollar, levels not seen in decades. Import-driven inflation, already painful, could accelerate significantly. And the apparent revival may be spending down reserves rather than building sustainable wealth. Here is the test. If the stock market rises 30%, but the currency falls 20%, and inflation eats another 10%, are you actually richer? That is what an Indian summer looks like. Beautiful, but do not unpack for winter. While the West and North Asia face headwinds, the South rises. If there is a region that emerges from 2026 in a relatively strong position, look here. Malaysia, ascending the semiconductor value chain, moving from packaging into advanced design. Data centers proliferating. Indonesia, sitting on the world's largest nickel reserves, essential for electric vehicle batteries, transforming from raw material exporter into processor and manufacturer. Vietnam, absorbing manufacturing redirected from China, the world's new factory floor. And Singapore, the ultimate chaos insurance destination, a stable city-state where wealth parks when it is nervous about everywhere else. Not risk-free, but relative to other regions, the positioning looks favorable. When the big powers struggle, the nimble ones attract the capital. Here is a fascinating historical observation to keep in your back pocket. Major financial crises tend to cluster around years ending in 8. 1998, the Asian financial crisis. 2008, the global financial crisis. 2018, the US-China trade war escalation. If this pattern holds, the next major crisis year would be 2028. History rhymes. It is not the end. It is a cycle. And that makes 2026 and 2027 a critical preparation window. Not the crisis itself, but the window before it. Use these 2 years to build financial resilience that can withstand whatever 2028 brings. All right, we have mapped the terrain. Now let us talk strategy. Principle 1. Hold more cash than feels comfortable. This is not cowardice. This is dry powder. The best deals in history have always gone to those who had cash when everyone else was scrambling. Buying opportunities appear when others panic. Principle 2. Absolutely avoid leverage. In a volatile year, borrowed money is not a tool, it is a weapon pointed at your financial future. And the trap to watch for? Late-stage euphoria. When your neighbor starts giving stock tips, that is not a buying signal, that is an exit signal. The smart money has already left. You do not want to be the last one holding the bag. Beyond investments, your career. In a transforming economy, the most valuable professional asset is not any specific skill or credential. It is the ability to pivot. Action step. Build a second income stream. Not quitting your job, building something alongside it. Freelance skills, consulting, a small side business, anything that reduces your dependence on a single income source. And if your industry is one of the sectors facing disruption, legacy automotive, commercial real estate, traditional media, now is the time for honest, calm assessment. What transferable skills do you have? What growing industries could use them? For business owners, the practical wisdom is simplify to survive. Cut expenses that do not directly drive revenue. Maintain cash reserves. Do not expand aggressively into untested markets. Here is the truth that separates survivors from casualties. Companies built on substance survive the tide going out. Those built on hype do not. Focus on what you do best. Do it exceptionally well. That is the strategy. Now, for the anxiety that comes with all of this. Here is a practice that actually works. Take a piece of paper, draw 2 columns. Left side, what I know. Your income, expenses, savings, debts. Just facts. No stories, no worst-case scenarios. Right side, what I do not know. Market moves, job security, prices in 6 months. Notice, these are all things you cannot control. Now ask yourself one question. Given what I know, what is one prudent step I can take this week? Take that step. You have moved from anxiety to agency. And that shift, from worrying about what you cannot control to acting on what you can, that is where financial wisdom actually lives. And finally, the perspective that makes all of this not just bearable, but exciting. Wealth is created in the recovery, not the boom. The Great Depression led to the longest economic expansion in American history. The dot-com crash cleared the froth, but built the foundation for the modern internet. 2008 created buying opportunities that generated enormous wealth for patient investors. The same pattern will apply to whatever correction 2026 brings. Your goal is not to maximize returns this year. It is to arrive at the other side with your foundation intact and your mind clear, ready for what comes next. Do not let fear paralyze you. Do not let greed blind you. The calm middle path, that is where the wisdom is. This content is based on cyclical pattern research from the 2026 World Prediction Conference and the Tai Research Institute. It is for educational purposes only. This is not financial advice. Past performance does not guarantee future results. Please consult qualified professionals for investment decisions.